Hello everyone. We are back to talk about the recent macro news and markets. I'm Prachi Devskar, co-founder at Lotus Dew, and Abhishek Banerjee, also co-founder at Lotus Dew.
Yeah, glad to be here, and thanks everybody for joining again. I think Prachi and I, we discuss markets every day, and what we thought we can do is bring some of our thoughts to YouTube via our channel, so that you have an understanding of where we are coming from, what we are thinking, what we are seeing in terms of data points. So yeah, Prachi.
Yeah. So Abhishek, some macro news came out this week. So your initial thoughts on that?
Yeah, I think the biggest macro news today, for example, today morning there was a PMI number, HSBC PMI number, but last quarter the GDP was only 5.4%, right? And that was a shocker, because I think a lot of people assume that India should grow and must grow at above 8%, and anything below that, it's really doing pretty bad. We have to remember that that came up from a very strong base because of post-COVID inflation. And secondly, last year was election year. Just to put in context, Prachi, we were discussing, I think till October, November, the government capex was very poor, because people were distracted. There was election. There was no actual budget that was actually announced. It was a vote of account. So things really started to get into gear only in November, December last year, and we are in February. And there is a 90% increase in government spending, right? So we see that number, we see that spending coming in. We see, of course, the big tax cut that puts 1 lakh crore into the hands of consumers. Whether they spend or not, we don't know. But typically, these consumers, who are marginal spenders, they are the ones who are going to actually spend. They will probably spend on things like discretionary items, be it white goods or precious jewelry, or I think maybe some vacation. But it's people are getting more and more conscious of actually owning stuff and saving money, and that's a little bit of paradigm shift from assetless growth. Right?
Yeah. And just building on to that, even though the third quarter the GDP growth was not as expected, the overall for the fiscal year 24-25, there has been an upward revision in the estimate for the whole year growth of GDP. And so what that means is that the fourth quarter is expected to look really good. And again, building on to all the things that Abhishek said, so we are expecting a solid fourth quarter.
Yeah.
The other thing is that there is, of course, clouds in the global macroeconomic environment, and within that, India continues to kind of remain very, very solid. So I think this is a very, very positive.
Let's count it on fingers, right? Weaker rupee, good for India, check. GDP as per estimates 6.2 this time print, which is higher by almost 25% from last quarter, check, right? We have government capex coming in, which is going to increase spending, check. We have a healthy correction in the market, which puts valuation in so-called acceptable limits. I was just discussing trailing PE. I was actually, Prachi noticed that trailing PE is, I think, what?
Yeah. So with the severe market correction, right? So the trailing PE ratio, price to earning ratio of the indices Nifty and Sensex have now gotten quite low, and the previous lowest was right after the pandemic hit, right? So with this correction, we feel that market may have gone into oversold territory, right? And one of the reasons for this could be that a lot of new investors came into the market after the pandemic, and this is their first experience of a sustained market downturn. So that may have resulted in some panic and making market go into oversold territory. So we think it's good time
Yeah, of course, it's a good
to
opportunity.
get in, particularly for long term investors.
Though the risk that people are pointing out, and we notice it as well, is that the broader market is actually has corrected more than the Nifty index, which means the smaller and mid caps they have corrected more than Nifty as such, and that usually is the right thing, right? Where your small caps and mid caps are higher risk stocks and they correct, or they go down more than the large caps. I think that is very well expected. And just to put it in context, the risk of an index like mid cap and or Nifty, 20% up or down in a year is very much within the normal limits. So from where we look at the checklist of what are the growth factors going forward, I think maybe a very concentrated portfolio of few stocks where you have high conviction stocks, or a good global macro theme, that might be a good idea going forward.
Yeah. And again, it's very hard to time and tell exactly when the market will turn and start showing green shoots. But for a long-term investor, it is time to invest. The valuations look very reasonable after this correction. This is not to say that the panic will immediately stop, right? We don't know for sure when the panic will stop and markets will start bouncing back. But for long-term investors, this is kind of a good opportunity. Again, always good idea to kind of pay attention to your comfort level with risk, because these are also uncertain times, particularly with the global uncertainty about the wars. It looked like it was going down, but doesn't appear to be the case. Also with tariffs and so on. So global uncertainty will remain for some time. So always keep your allocation and your risk appetite in mind.
Yeah, and see, broadly, it is very important to be comfortable, right? I think the most important thing is what is risk actually? It is risk like what makes you comfortable with your current valuation of assets, irrespective of whether the markets have gone up or down. Right? That's kind of what your risk tolerance is. I would like to say, it's not really the panic, right? Panic is when you are like seeing people pull out money left, right, and center. I think what is happening is also from we counted the positives, right? The factors that can potentially help you make good returns going forward. But also, what is also happening is that there is a record amount of FII money that has been pulled out of market. During February, March, people have their tax planning payments due. Real estates that have been sold without bank loans, they have their payments due in this month. So there's a lot of demand for capital away from listed markets into other forms of investment, which come back in the listed market in some time, right? So for example, if it's tax planning, people who invest in equity-linked savings schemes, so they take out money from one pocket and put it in another pocket, which is actually long-term. So, or PPF, now that EPF is allowed to invest in equity, for example. So it's just a left pocket, right pocket transaction, and therefore there's a lag, and therefore it opens up a window of opportunity for you to kind of get in when such opportunities arise. Really.
Yeah, absolutely. Should we take some questions from last time? Just to again remind everybody, whoever has watching live and has questions, we will take those questions as well. But also, if you watch this later, please post your questions in the comments and we'll take them up next time.
Yeah.
So these are some of the questions that were posted on our last week's video, and so we will
take them. So there is a question by Simran Nangia who is asking, would it be wise to reduce debt in this environment, or should I leverage low interest borrowing?
I think if you're thinking about levering up for investing, this might not be the best time, because already the markets are very volatile, and levered position will only amplify the risk. So again, keep in mind your comfort level and your risk appetite. We certainly think it is time to invest and stay invested in the market. I'm not sure whether levering up would be a good idea. Abhishek, your thoughts?
So she's actually asking about reducing debt or leveling up on debt too. But example for not definitely not for markets, I
Correct,
agree.
correct.
But if it's for real estate, right, that's a liquid asset. Overall, Indian inflation will be on a downward trajectory. Like any kind of innovation increases the lifespan or utility of a product, or decreases the price. So as long as economies are innovative in nature, inflation on a structural basis should come down. To that end, right, if you buy real estate and you level up, you currently it's not a very low interest rate environment either, right? India is decent amount of interest rate, but we did have the first rate cut, which is also actually a positive for market. I think I wouldn't say this is really the best opportunity. I'm kind of quite neutral whether you want to level up. It really depends on your security around ability to service the debt.
Yes, absolutely, and but also as Abhishek rightly pointed out, what is the purpose of this debt? If you are if you want to buy real estate for your own as your first house, this may be a good time to think about it. But again, only the first interest rate cut has happened, and over some time we expect interest rates to go down even further.
Yeah, and for example, buying a vehicle like autos have done recently pretty well. So autos are definitely contributing to the GDP, another positive factor. The next question is from Aditya Chauhan, who is asking, Birla is entering into cables and wire industry. So as you guys know, Ultra Cement announced that they would be in cables and wires. That caused a pretty steep correction in stocks like Havells, which are also in that business, but only a portion of their revenue. Birla successfully kind of did well in their paints business, so they have a paint arm. Now they are trying to go into cables and wires, and I think these are ancillary businesses, but just to put it in context, they have allocated 1,800 crores. That's going to take 2 years to deploy, and setting up a new factory, greenfield, permissions, delays, labor, land, these are again like challenges, and then from there they have to capture market share. So it's a 4 or 5 year away event. On the back of that, the stocks that already have market share have corrected. So definitely, you can evaluate, and I think it's a good opportunity to look at those stocks as a buying opportunity, right? And then obviously the last.
Oftentimes there tends to be an overreaction to big news like this, and then many times they turn out to be if there's overreaction on the downside, they turn out to be good buying opportunity, right? But it remains to be seen how these other companies in that sector would be truly affected by entry of this big gorilla.
And sometimes in a fatigued bull market, people are just looking for a bad news to sell, right? So for example, if you remember, there was a time when Cyrus Mistry had alleged corporate governance lapses in Tata Group, and all Tata stocks fell, right? And we look at Tata as a role model in corporate governance. So even then, people didn't want to kind of believe that story. Then we saw the Adani episode where a lot of the Adani stocks got impacted because of the Hindenburg research note. So these kind of events keep happening, and so the impact of Ultra Cement going into cables and wire business and how the other stocks corrected, these kind of things are actually overreaction in a way. So the last question for today, I think it's from Utkarsh Sharma. He's asking, the small and mid caps have fallen 20%. Officially, both have entered bear territory. Will they continue to fall as they did in 2017-18? Or do you expect a recovery in the near term? Market timing question, right? So yeah, I wish I knew the accurate answer. We can have a conjecture. I think it's not impossible to predict what will happen, but
in the near term, near term, yeah.
So I think Prachi, what do you think?
No, so I think as we also talked earlier in this episode, that when markets correct, typically small and mid caps are affected more and correct more. But when markets bounce back, these are the stocks that they will also bounce back faster and more, right? And so we definitely expect small caps and mid caps to bounce back. Near term, we don't know because of combination of these things. Even though macro news is good, investors sentiment may be still too pessimistic, and that is the reason we can't say whether in near term it will happen or not. But definitely for long term investors, there is opportunities to buy, particularly high quality small cap and
And right now, consumers are actually financially quite constrained. So, I mean, I was reading a report that almost all Indians apparently do not have a lot of discretionary spending power left. And it's a fact that in India, investment is a discretionary purchase, which means though technically you should save before you spend. A lot of the people in India just spend, and then whatever is left they invest. So that position of liquidity available for additional purchase, be it in their own personal consumption or investing, that is kind of quite constrained in India right now. So that is also some of the impact that we are seeing. But surely, I think it's a very steep and rapid correction that we are seeing in small caps. Though the amount is not that high, I mean, it can be much worse, but the time in which it has happened is pretty sharp. So this also opens up another opportunity that typically this will be a to my mind pretty a quick reversal when the markets reverse, because I think most of the selling is technical in nature, because we don't really see a lot of fundamental issues, and maybe we are missing something, but as of now we are not able to kind of say why this is not a buying opportunity.
Yeah.
We have few live questions.
Okay. Sanket Kumar, part 1. I am a first year MBA student, really impressed with what you do. Thank you very much. I would also want to learn quant finance. Part 2, I am from non-tech background. Can you tell me where to start? So I think, firstly, quant is very tech, right? And what I mean by that is, there are two ways to make money. Either you know something better or you know something faster, right? So better meaning like, you have different sources of measuring what the value of an intrinsic value of an asset is. For example, we tend to use corporate governance as a adjacent indicator for value. Or something faster where you're trying to do algorithmic or high frequency trading where you're trying to react before others can react. So without knowing tech, you're really constrained in only the domain of statistics. The best bet you really have is either to learn programming or partner with somebody who knows programming but does not know markets or finance well, and do it together as a team.
Yeah. The other way to understand is start with some well established strategies, and see if you can understand their basis and if you can replicate them on your own. Like one of the simplest strategy, and that has done very well, and now it is offered by many mutual funds, is a momentum strategy, right? And so you can start there and kind of learn your way by doing.
One thing I would like to point out, actually asset allocation is 90% of your returns. Like so something like a black determined model, which is also quantitative in nature, but you can actually do it on Excel. You can explore that. I think that just taking mutual funds and doing your own asset allocation probably would give you a lot more benefit at trying to select stocks using quantitative finance if you want to develop in that area. The next question is from Black. This user is saying markets have been experiencing significant decline over the past 3 months. Should I invest now, or would it be wiser to wait for some time? You can stagger it. I think it's a timing question. It's always difficult. We also don't know. I think anybody who claims to know that they have a short-term view of 7 days, I've never seen that being consistently right with anybody.
But having said that, right, we don't see any reason to wait for the perfect moment, right? That's the flip side of this argument, so we think you should start, and you can kind of if you have a lump sum to deploy, you can kind of deploy it in a staggered manner. If you're thinking of starting an SIP, this is a good time to start.
And I mean, I can give you my personal opinion. This is again not a recommendation, but if I have spare money to deploy, I would deploy lump sum right now. That's what I would do, right? And that is my conviction, my risk appetite, what I want, what I think of the market. But again, I would do it with knowing that I might not be right. So that's something which you have to take into account. And finally, there's a
and again, both these recommendations are keeping in view the long term gains that you're likely to experience.
So there's a question from Aditya Shahan: how does rise in GDP affect inflation and interest rates in the short and long term? So usually higher GDP is coupled with higher inflation. So GDP degrowth and high inflation is called stagflation, right? So that's not a good situation. So typically,
And we saw that during the pandemic, and there were very strong structural reasons for it, with supply chains being disrupted, right? So usually that is coupled with some sort of supply side reason.
Yeah. So I think one thing you have to notice is that countries are in a tariff war. So while we are looking at it from this government is doing this to that, but ultimately the consumers pay, right? So tariffs are basically tax on consumers, right? Which means that if a country is producing goods or services that are not the best in the world, they are protecting that market by making those consumers in that market buy that product or service, because the imported product or service becomes way too expensive, right? And it's an inferior product, which means either the price of the product is less or the cost of the product is high. Both are inflationary in nature, because that requires replenishment of the product life cycle. Tariffs are inflationary. GDP growth is generally inflationary. Interest rates do not come down in the inflationary environment, right? So you, in the long and short term, I think interest rates might come down in India, because India has a lot of efficiency gain to accomplish from the leakages that were there in various machineries of the economy, right? So just like staying there and then taking care of leakages already gives us in kind of a lot of efficiency, and that efficiency basically brings down inflation more than whatever is happening on the GDP growth side. So that the formalization of informal economy and so on. So there are different vectors under which India is operating versus what the Western countries are operating.
Having said that, there is also India does not live in an isolated world. It is connected to the global economy, and so if global inflation is high and central banks around the world feel the need to keep interest rates high, then that also puts pressure on Indian interest rates to stay high. So it really depends upon how the tariff game plays out globally, and as Abhishek rightly pointed out, generally with higher tariffs there is inflationary pressure.
Yeah, I think I think we'll keep watching, and do join us next week again when we update our views on the updates over the week and how things have shifted, and what our views, how our views have shifted. So look forward to interacting with all of you again, and thank you for all the interesting questions.
And feel free to post more questions in the comments. We'll take them up next time.
Next time.
Thank you very much.
Certainly. Thank you. Bye. See you next week.